This is Mike Durr, the Kingwood Mortgage Guy, and we are starting off January of 2017 in the first Tuesday night webinar. A couple notes is that we are going to start the webinars at 6 p.m. from here on out, and hopefully that would fit into your time frame. Also, the fact that we are putting and posting all of the webinars up on the website, you are encouraged to go to the Homebuyer Webby. To be here live gives you a chance to kind of communicate with me, and we can bounce questions back and forth and answers and stuff like that. But because the site is grown dramatically in this last year with all the content that we put on it, and we even plan a lot more for this year, then I would obviously always appreciate it when you show up. But if you're just looking for information, there's going to be a ton of information. Not only already is a ton of information, but there's going to be a lot of information on the homebuyerwebby.com for the rest of the year. So, and hopefully going forward. So again, looking at this screen, you can see down here that homebuyerwebby.com is the site where this is going to be on, and it's what we are talking about right now. Tonight we're going to talk about how the appraisal affects you in the mortgage loan process. And I got this question from one of the guys I'm working with just recently as a first-time home buyer, and I don't know if he anticipated that the appraisal was going to come in low or if it was going to come in high, but he was trying to get an answer to that question. And so tonight we're going to go over this. I'm assuming that when anybody asks me a question like that, there's probably a lot of other people that want to know the same thing. So with that, we're going to go. At this point in the webinar, I just like to introduce myself. I call myself the Kingwood Mortgage Guy. I've been in the mortgage industry. This is my 21st year, and I want to make sure that you can reach out and contact me. You can call me at 281-348-9899, and or you can go to kingwoodmortgageguys.com, which is my main primary website. And then my Homebuyer Webby site is really just where we load the information for that we put on in these webinars and some previous videos that I did that seem to have resonated with a lot of people. So anyway, that's enough of that introduction. One of the things you're going to find is that I'm going to go through this stuff quickly. The premise of the webinars is to give you a kind of an overview, a general look at what the information would be. In some cases it'll satisfy you. In some cases you may have to call me to get more information, and I encourage that. Okay, so here's what we're going to cover. I always like to put this on here because you may not want to know any of this stuff. It'd be a good time for you to go do something else. But if you'd like to find out why we need an appraisal, then we're going to go over that. Who chooses the appraiser? Get this question a lot. So we'll talk about that. What does the appraiser do? How do you get a copy, or do you get a copy of the appraisal? How much does the appraisal cost? And what happens if the appraisal comes in lower than the sales price? Or in that case, what if it even comes in higher? We're going to talk about all of those things. So I'm not going to dilly-dally here. So first one, why do we need an appraisal? Well, the reason we need an appraisal is that the lender is using the property as the collateral for the loan. Now obviously they want to check and make sure that you have good credit, that you have stable income, and that you've handled your obligations the way that you should have. But the main thing is, if you don't pay the loan, guess what? They take the collateral back. So the house is collateral for the loan, and when a lender makes a loan on a property, they are using the property as collateral, and they want to know how much it's worth. That's why they enlist a third-party independent appraiser. But it also has a couple benefits for you. It provides you, as the buyer, a comfort knowing that the market price that the appraiser comes up with is consistent with what's going on in the marketplace at that particular time. Now, lenders don't like to accept appraisals that are more than a couple months old. That's because the real estate climate changes. It can, I mean, you've seen where it's a buyer's market sometimes, it's a seller's market sometimes, and a lot of times it just depends on the time of the year. We don't like to accept appraisals out of a season, so it's just one of those things that it's not the absolute value of your property for the rest of your life. It's just a value that was given to your property in a specific 3-month period is generally what people go for. And also the appraiser is required to give the methodology that he used to value the property. And we're going to go into more of that on a couple of the next slides. So anyway, hopefully that's helpful. And I see a question or two. What I'm going to do is I'm going to ask you to wait till the end. I'll go through this as fast as possible and we can answer the questions at the back end, okay? Okay, who chooses the appraiser? It's not unusual for me to get a response from somebody and say, well, can I use my own appraiser? Well, unfortunately, no. Back in, I think it was 2009 when they came up with the HVCC. I think it's the home valuation. What is it? It'll come to me. Anyway, the premise is that they want to make sure that the appraisers give a fair value to the consumer and to the lending institutions. So I'm going to read this part of it. The lender chooses the appraiser. Really, we choose an appraisal management company. But since May of 2009, when HVCC came into effect, they're ordered through an appraisal management company. Now, this management company contracts with area appraisers, and what they do is they're basically put in a rotation wheel. And here's what HVCC is. It's a set of federal guidelines designed to enhance the integrity of the home appraisal process and for it to be more reliable. It's also there to restrict the interaction between mortgage lenders and appraisers, so they don't want anybody in cahoots together. I don't know if cahoots, that's definitely a South Texas or at least a Texas term. If you're in cahoots with somebody, that means you're partnering with them or you're negotiating. I don't know what negotiating is. Shoot, it's just cahoots. All right. So if you're from Texas, you know cahoots. It also restricts the interaction between the mortgage lenders and the appraisers so that they're not doing anything that they shouldn't be doing. Now, lenders can no longer work directly with appraisers. And I will tell you that a good friend of mine, somebody that I care about, before this law came into effect, we'd done thousands of appraisals for the companies that I'd worked for. I trusted him. I still trust him. I just don't get to choose him. And I think that's not necessarily a good thing. But for the masses, you know, when they make regulations, what they do is they make regulations for the 1% of the people that are making it, that are doing the wrong things. And sometimes the 99% has to be, I don't know if it's punished, but you have to make adjustments so that you aren't taking advantage of anybody along the line, I guess. I don't know. I don't like it. It is what it is. It's regulation. Anyway, lenders can no longer work directly with appraisers. Instead, lenders must schedule appraisals through third-party management companies. This adds a buffer between the lender and the appraiser. So if a buffer is what you want, then okay. Now you look at my picture here of the appraisal oversight. When the mortgage meltdown happened in 2006, 7, and 8, this is what government version of fixing a problem is. And you can see that it looks almost like a bowl of spaghetti and meatballs. I mean, there's so many people involved that I'm sure that there's a lot of duplication. There's a lot of extra money spent. And the truth is, I'm not sure how effective they are at that. But I'm going to get off the political stuff and we'll go on to the next slide. So what does the appraiser do? Well, that's always a good question. So the appraiser looks for similar properties that have sold. We say recently. When I say recently, they like to go back about 3 months. If they can't find enough comps within 3 months, they'll look back 6 months. They don't like to go much further back than that unless it's some kind of unusual circumstance. And they're looking for properties that are comparable with the subject property. The subject property is the home that's being appraised, or the home that you're buying, or the home that you might be refinancing. So they're going to compare those. They're going to compare the age of the house, the square footage of the house, the rooms, how many rooms are in it, the amenities, you know, whether it has granite countertops or granite in the bathroom. It's going to compare the lot size. It's going to be the type of house. whether it's a brick house or a frame house or a one-story versus a two-story. It's going to compare the neighborhoods, and the list goes on, but those are the main ones. So that's what the appraiser is there to do, is to compare those. And then what he's going to do is he's going to put values based on, of course, a home with more square footage is going to have a factor that makes it a little more valuable for the square footage it has. If it's in a less desirable neighborhood, even though it's bigger, they'll put another value, a negative value, on the fact that it's in a less desirable neighborhood. The age, obviously newer homes in many cases are sometimes considered more valuable because they have newer roofs and newer plumbing and newer foundations and all that kind of stuff. So there's a lot of things that go into appraisal, and when you see an appraisal report, you look at it's pretty consistently 29-30 pages of micro print. I mean, it's very small print, and there's just a lot of data there. And of course, that's what the appraisers do. They fill in all that data and they come up with an evaluation. It's an opinion of price. It's not the market price, because the market price is what people will pay for it. But in many cases, the appraisers are considered experts at what they do, and obviously that's based on their experience and the amount of appraisals that they've done. Okay. Comparable properties. I pulled this off the MLS, and I did this on a neighborhood that's in the Kingwood area. It's the Bear Branch subdivision, and I just wanted to point it out a little bit. What you've got here is you got the lot size, you got the square footage. So what I did is I put a range of homes between 2,900 square feet, well, I guess it was 2,800 square feet, and probably 3,200 square feet. So that's a pretty tight range. And then what you look at here is you look at the listed price, and they go, in this case, from lower to higher. You can see that 224, 228, 239, 244. So there's almost an $80,000 difference between the homes priced in this area. Now, why do you suppose that there's that big a difference in pricing? Well, it could be the condition and quality of the home. The lot sizes are pretty consistent. You can see that they're all around 10,000 square feet on the lot size. They're all pretty much in the same area. Now, there's a couple of outliers here. These are map codes. So if you were going to look at the map codes, you'd see where these were. Year built, all built 77 through 1980. So they're all, 35, 37 years old. And then the number of bedrooms, we do see that there's only one 5-bedroom property here. And then here are the actual sale prices. Now, these are homes that have been sold. There is additional information with the addresses and stuff. I didn't put that on there because I didn't think it was necessary. But you can see that the price range is actually more than what the list price was. This one was discounted a little bit, where that one was discounted a lot. And that's an indication to me that the value, or the way that the home was kept up and the amenities that were in the home make a pretty big difference there. One of the things that appraiser will look at is there's a pretty big difference between a 230 price home, and then all of a sudden right in here you're up into the 272s, the 280s, and the 298s. You kind of wonder what's going on. Are these in a different area? Well, it doesn't look like it, because, well, 296Z, would be interesting to find out. Well, these are 296C. So anyway, there's a lot to look at when you look at appraisals, but I thought that this was helpful. Now, you notice, just an FYI, if you have any questions on this, here's my number down here. I want you to call me. Feel free to call me. Obviously, I'm not going to answer the phone all the time, but I'm going to answer it most of the time, and I'd love to chat with you. Okay, do you get a copy of the appraisal? Yes. That's anything else? You get a copy of it, I promise. If you obviously, if you pay for it, you get a copy of it, so that's good. How much does the appraisal cost? Well, it's going to vary, and it can be by the property. If it's a big property with acreage, it may cost more. If it's a huge home, 4,000, 5,000, 6,000 square feet, the appraiser may charge more. If it's a smaller property, and it could be anywhere from 1,000 square feet to 3,000 square feet, you're probably going to have a similar price. of somewhere between $450 and $575. And one of the things I like to point out on this pricing thing is that if you remember on the slide that we went through previously, we talked about an appraisal management company. Now, the appraisal management companies get paid to manage the appraisers. So unfortunately, not all that price goes to the appraiser. A fair amount of it does, but the appraisal management company does get a cut of that, and of course they control that money. So it's one of those cases that's obvious where the regulation caused the price of the appraisal to the consumer to go up, because now there's another layer of management that didn't used to be there before. Oh well. Okay, so what happens? This is really where the crux of it. What happens if the appraisal comes in different than what the sales price was? And it can be a really good thing, or it can be kind of a poopy thing. But it's usually not necessarily negative as long as you know what to do about it. And so here's what we're going to suggest you do. First question is, what if it comes in low? So you've bought a property, and let's say it's a $200,000 purchase price. You agreed to pay $200,000, but the appraisal came in at $195,000. What happens? Well, the first thing I would tell you is it's time to renegotiate. You've got a pretty good, you've got a good report that a independent third-party expert came up with a value, and you can take this to negotiate with the listing agent and the seller so that you can get the price down to what the appraisal price is. That's probably the best thing you can do. If you're the seller, you can argue and provide new comps that possibly the appraiser didn't see. If you do that, that's it takes some effort. They're not real keen on changing their appraisal opinion, but they do. I've seen it happen recently, as a matter of fact. In this case, the seller thought it was worth more than an independent third-party expert, and you'd ask what their expertise is. If this guy's appraised hundreds of properties, thousands of properties, his opinion has to have value. Here's the catch. The loan is going to be based on the lower of either the sales price that's in the contract or the appraisal. So what happens is, if you're tight on money, if you're just getting by with the amount of down payment, and the seller won't budge by coming down. In other words, he says, you know what, I think it's worth $200,000. I don't care what the appraiser says. If you want this house, you're gonna have to pay $200,000. That would mean that you would have to come up with not only your regular down payment, but you'd have to come up with the extra $5,000, because the loan is going to be based on that appraised amount. So that will kill a lot of deals, particularly if you don't have the extra money. Now, I can tell you that I'd say 7 out of 10 of the sellers will usually come down. There's always 3 guys out there that just won't. They won't negotiate. Now, let's shift gears now. What if the appraisal comes in high? And this happens a fair amount of times. The good news is you just got a bargain. You've got built-in equity that you bought, so you bought the home right. I mean, you did good. So you can thank your realtor for finding you this property and helping you negotiate this property, because you've bought some value there. And that's always a good thing. So anyway, obviously I just kind of scratched the surface of talking about appraisals. When I spent 10 minutes, 15 or 20 minutes. Anyway, I want you to call me. You can call me at 281-348-9899, and just to kind of go through this. Here's what we covered. Why do you need an appraisal? Who chooses the appraiser? What does the appraiser do? Do you get a copy of the appraisal? How much does the appraisal cost? And what happens if the appraisal comes in lower than the sales price? Now, just know that this is, when I said how much the appraisals cost, this is January 2017. If you're watching this video and it's 2020 or 2220, then guess what? They're probably not going to be, they're a little different than that. But this is Mike Durr, the Kingwood Mortgage Guy. I hope I'm around in 2020. Yeah, I'll be here talking to Homebuyer Webby. Call me at 281-348-9899. And finally, I am the Kingwood Mortgage Guy. I'm proud to be living in Kingwood, working Kingwood. Just a FYI, I do loans all over Texas. I'm licensed in Texas, and I just finished doing a couple loans in San Antonio, do loans in Dallas all the time. Love to have that chance to work with you. If you ever want to call, I promise I'll answer your phone calls, and I'll be transparent as I can be. Talk to you soon. This is Mike Durr, Kingwood Mortgage Guy. Bye-bye.